Good evening, Canada. It's week 10, the final chapter of the Investor's Guide to Thriving for the spring season. And fittingly, the Dow today closed in record territory, and most assets on the planet are not too far behind. I wonder what will happen during the break between now and when we see you again in October for the fall Investor's Guide to Thriving season. Will this be a year where the famous sell in May and go away seasonal pattern holds up, or will markets move even higher? So far in May, investors have rotated away from tech and growth stocks, with valuations viewed as stretched, especially as prospects for rising rates increase. And given the strong stock market rally over the past year, some worry that the easy positive catalysts for equities may be running out. Recent Bank of America data showed that institutional clients sold equities for a third week in a row last week. Hedge fund clients posted their largest outflows in over a month as equity sentiment nears euphoria. Well, it sure seems like the world today is a bit like a casino. The shots are flowing courtesy of Pfizer and Moderna, and the government has taped forget about it over the zeros on the roulette wheel. And when the dealer's showing an ace, insurance is available, but are there any naysayers left that think this is all just a house of cards? Well, if you think you might need a little help managing risk in your portfolio, Larry and company at ETF Capital Management can help with strategies designed to tame the markets so you don't have to time the markets. ETF Capital Management works with advisors through our parent company, Quintessence Wealth, and clients, and plus we run some institutional mandates like the ETFs and funds of ETFs in partnership with BMO Global Asset Management. You can learn more at etfcm.com. For those who have their investments managed and want to layer on wealth planning strategies, U-Potential is our fee-for-service financial planning firm. And if you just want to read about money, Golden Girl Finance is the original financial media site for women in Canada. And completing our group of companies, the Investor's Guide to Thriving series is brought to you by Prosper Experiential Media, which is our in-house marketing boutique exclusively serving Q Wealth and its partners. We bring you Investor's Guide to Thriving in support of childhood leukemia at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation. If you'd like to make a donation, please use the links in the survey you'll receive after this event, or visit investorsguidetothriving.com and use the links on the page. They allow us to track and match your generosity. And if you've already donated, Larry and I thank you very, very much. A big thanks goes out to our title sponsor, BMO ETFs. Back in 2009, at the end of their first year in business, Larry and I joined the team at BMO ETFs to celebrate the first anniversary and their first $1 billion of assets. And in the 12 years that have followed, BMO ETFs has rocketed from 1 to over 70 billion in AUM in a literal tour de force of leadership and innovation. Well, folks, to see growth like that in your portfolio, you'll need to look beyond blue chip thinking. And that's the subject of tonight's BMO ETFs educational topic. Here to show you how ETFs can provide targeted exposure to small and mid caps in your portfolio, here's Erica Toth, Director with BMO ETFs.
Pleasure to be with you all this evening. So we're all familiar with the S&P 500. Tonight we're going to be doing some education around the S&P 400 and the S&P 600 indexes, what they are and why now might be a good time to consider them for your portfolio. So the S&P 500, as we know, is comprised of the 500 largest companies in the United States. It's one of the most popular indexes in the world, as well as the most popular benchmark of the US stock market. The S&P 400 is the US mid-cap index, and the S&P 600 is the US small-cap index. So for a little perspective here up on the screen, we know that the US market, the US stock market is the largest in the world by far, but on a relative basis, the S&P 400 mid-cap index is actually larger than the entire Canadian stock market. It's also larger than the stock markets of France or Germany. The S&P 600, the small cap index on the other hand, is similar to the size of the entire stock markets of India, Sweden, or the Netherlands. Now, if we look at the S&P 600 small cap index on the next slide, the exposure is actually very different when you compare it to the S&P TSX Canadian small cap index. In Canada, we have exposure to 233 stocks. And much like our large cap index, the small cap index is also very much tilted towards materials, energy, and industrial sectors. The S&P Small Cap 600 Index gives you exposure to 600 stocks, on average much larger in size in terms of market cap. This index is much more diversified compared to the Canadian counterpart and provides you with sector exposures to industrials, financials, consumer discretionary, and IT, to name a few. If we move on to the next slide over here, why might this be a good time now to consider complementing your core S&P 500 exposure with US small or mid caps? Well, as the economy is reopening and as vaccination rates go up, GDP and consumption in the US are also likely to grow. The S&P 400 and the S&P 600 will give you a higher beta to that reopening trade as they are more correlated to US growth than the S&P 500. If we take a much longer term perspective on the next chart over here, so beyond just the reopening of the economy post-COVID-19, this chart over here is based on over 26 years of data. It goes back to 1994. So over very long-term time periods, small and mid-cap stocks tend to provide higher returns. The S&P 400 and 600 indexes can be used tactically after a market decline, like we saw last March, or as long-term growth holdings to complement your core index allocations. It should also be mentioned that with higher potential returns, they're not without risk. They do come with potentially higher levels of volatility. And although we are seeing a strong trend of outperformance, especially over the last year in small and mid caps, there will inevitably be some periods along the road where they do underperform their large cap index counterparts. If we look at the following slide, there's a few key takeaways here that I want to highlight when comparing the S&P 400 and 600 to the TSX, to the S&P 500, or to the S&P TSX Small Cap Index. The first point that I want to highlight here, first key takeaway, is that US small cap companies are on average almost 3 times larger than Canadian small cap companies. Second key takeaway, the S&P 400 and the S&P 600 are far more diversified and less concentrated than the S&P 500, the TSX, or the Canadian Small Cap Index. In terms of volatility, this is the third key takeaway that I want to highlight on this slide over here. When we look at 3-year and 10-year volatility levels, US small and mid caps, while they are more volatile than the S&P 500 or the S&P or the TSX, they are slightly less volatile than the Canadian Small Cap Index. Last thing I'd like to highlight on this slide here is valuations. Now, US small and mid cap valuations, despite very strong performance post-vaccine news in November, their valuations are still more compelling than the S&P 500 and could still have some catching up to do. Now, moving on to the next slide, let's talk a little bit about the level of concentration in those indexes for a moment. So the light blue line on this graph over here represents the S&P 500, the yellow is the S&P 400, and the brown is the S&P 600. What this graph is telling us is just how concentrated the S&P 500 is versus its mid and small cap index counterparts. In the S&P 500, roughly 20% of stocks, or the top 100 stocks, represent about 70% of the total weight of that index. If you're looking at the top 10% or the top 50 stocks, they represent approximately 60% of the total weight of the S&P 500 index. And just for fun, the top 10 holdings, I looked at it as of the close of the market today, currently account for about 27% of the S&P 500. So that's as high as it's ever been in terms of concentration. We touched on several reasons why an investor may want to be invested in US small or mid cap indexes, and here are a few more points to consider. If we move to the next slide, the S&P 600 tends to be more of a pure play exposure to the US economy. It provides what we call a domestic bias. More of the revenues of the companies held within this basket are derived from the home market, from the US, versus the S&P 500, which in contrast is dominated by large multinationals. A second point to highlight is the quality bias that's inherent in the S&P 600 in terms of the index construction rules. So in order for a company to be eligible to be included in the S&P 600 index in the first place, the company has to be profitable. And this is actually one of the key reasons why the S&P 600 has a history of outperforming other small cap indexes, such as the Russell 2000. We also touched on the fact that over very long time periods, the S&P 600 tends to have very strong historical performance. So over the last 25 years, the annualized returns are in the neighborhood of 11%. Now, why consider the S&P 400, the mid-cap index? Let's move on to the next slide. We talked about the diversification. It is less concentrated than the S&P 500. The top 10 holdings within the basket represent about a 6.5% weight overall, in contrast to the S&P 500, which, as I mentioned, stands at around 27% right now. The S&P 400 also provide higher potential performance over the long term. But there's also stability. So the mid-cap companies have already shown a certain amount of staying power because they've already gone through the transition from being a small cap to a mid-cap company. They've proved that they have better access to capital, they've managed their early growth challenges, and they've already established distribution. Mid-cap companies in the US also tend to be a bit of a sweet spot and tend to be acquisition targets. Now, what's in these indexes? If we slip onto the next slide here, let's look at some of the top holdings. ZSP, which is the BMO S&P 500 Index ETF, happens to be one of the largest and most liquid S&P 500 ETFs in Canada. You'll see here you're holding all the household names that you're familiar with. So Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, JP Morgan, and Johnson & Johnson. Now, if you look over to ZMID, which is the S&P US Mid-Cap Index that tracks the S&P 400 index in the middle, you have access to companies like Williams-Sonoma, Graco, and FactSet. FactSet provides data and analytics to financial services firms. On the right-hand side, you have ZSML, that's the BMO S&P US Small Cap Index, tracks the S&P 600. You'll see names like GameStop, Macy's, and Crocs. I will also point out that the weightings, as we talked about already in the presentation, the weightings in the names in the mid-cap and the small cap indexes tend to be a lot smaller, those positions, than the top holdings in the S&P 500. So a lot less concentrated, so that 0.84% holding in GameStop, it won't kill you if that stock goes down significantly. And we know there's been a lot of drama in the markets with GameStop this year, but you have exposure to a basket of 600 companies and a very well diversified basket. Now, if we move on to the next slide, looking at things now from a Canadian investor's lens, let's look at how the US mid and small cap indexes compare to the TSX from a sector standpoint. If you look at the bar chart to the left, the TSX is the dark blue line. As we know, very concentrated in financials, in energy, and in materials. The S&P 400 and the S&P 600, on the other hand, which are the yellow and the brown bars on that table, offer Canadian investors easy access to consumer discretionary, healthcare, industrials, and real estate stocks that we don't have access to domestically. The next slide looks at the same information, but the S&P 500 versus the TSX. Of course, none of this is going to be a surprise. With the 500, of course, you get that exposure to big tech and healthcare, also consumer discretionary and consumer staples. Now, moving on to the next slide, why use an ETF to access US small and mid-cap stocks? ETFs are powerful tools that provide instant diversification for any size of account. They're low cost, with ZMID being offered with a management fee of 0.15% and ZSML being offered at a management fee of 0.2%. They're transparent. The full list of holdings is published on our website, bmoetfs.com, on a daily basis. And with an ETF, you also have the choice of currency. You can buy it in Canadian dollars unhedged, you can buy it in Canadian dollars but hedged back to the Canadian dollar, or you can buy it in US dollar units on the TSX for investors who are already holding US dollar currency in their accounts. So I'll talk to that momentarily. If we move on to the next slide over here, I wanted to mention there are several ETFs listed in Canada that track the US small and mid-cap indexes, the S&P 400 and the S&P 600. Both BMO and iShares offer these products. On the BMOETFs.com website, you'll find a comparison tool where you can compare side by side up to 5 ETFs from any provider in Canada. On the next slide over here, here are the tickers if you do want to have a look and do your own due diligence. For the S&P 600, the US small cap index, there's ZSML and XSMC. And for the mid cap, the S&P 400 index, there's ZMID or XMC. Both the BMO and the iShares products are offered at the same price points. They track the same indexes, although the BMO versions are larger in size and more liquid. Now, a quick word on currency, as this is a really important point to consider for a Canadian investor when you're investing in the US and abroad. I mentioned earlier, BMO is actually the only provider to offer all three currency choices for the S&P 400, the S&P 500, and the S&P 600. You can go with the Canadian dollar hedged version if your view is that the Canadian dollar will strengthen going forward. You can go with the Canadian dollar unhedged version if your view is that the US dollar will strengthen. This way you participate not only in the returns of the underlying stocks, but also the currency. Now, with both of these two options, there's no need to convert US dollars in order to buy a US listed ETF now that these exposures exist here in Canada. So you save money on that conversion cost. As I mentioned, you can also purchase these ETFs in US dollars. So if you already have US dollars in your account to spend, the .U versions exist of both of these indexes. And why would a Canadian investor be better off buying a .U on the TSX instead of a US dollar traded ETF that trades on New York or on the NASDAQ? Well, it's better for a Canadian investor because you have no US estate tax exposure and no T1135 or foreign income verification forms to fill in come tax time every year. So it really helps with those potential headaches down the line. So thank you again for taking the time to join us. I hope you learned a few things in this segment. Moving on to the next slide, in addition to partnering with Larry on this webinar series, we also offer a weekly market insights webinar, which is held every Friday at 1 p.m. for half an hour. These sessions are also a great opportunity to further your financial literacy. And this week's focus is going to be on low volatility investing. My name is Erica Toth. I'm a director at BMO ETFs, and it's been an honor and a pleasure to be with you this evening. And with that, I will pass it back to Jared and to Larry. Enjoy the rest of the show.
Thanks very much, Erica. And it's the final show of the year. A great thanks to all our friends at BMO ETFs for providing an excellent educational partner. And once again tonight, Erica touched on some very key points on why ETFs are just such an elegant investment tool. And it's not surprised why I called my company ETF Capital Management once upon a time when we first got going, coming into the 15th year now. So it's been a great partnership. So thank you, Erica, and thank you so much to BMO.
Thanks, Larry.
Okay, so into the final one of the year. So as I highlighted this week on Berman's call, I talked about market breadth and some of the things we're seeing there. So I'm going to take a little bit of a deeper dive into that tonight. I want to talk about understanding what the equity risk premium is all about, and it's important because people are recognizing that we're in a bit of a bubble, and that bubble's been blown by easy money policies. In fact, the Fed released today their financial stability report. Lael Brainerd, who's a governor of the FOMC, and talked about as potentially Biden's choice to take over for Powell next year. Should he decide to change leadership there, chairs this committee. And basically, if you read through the headlines, the Fed is becoming very worried about asset valuation. Last week in the press conference, Powell was asked about valuation, And he used the word frothy for the first time. And he said, yeah, I wouldn't, I can't say that we haven't felt it was part of that. So obviously he knew this report was coming out this week and what it would say about asset valuations. At the same time, they can't back their support away because of the importance of what they've done to boost asset markets. So, that's one of the biggest investment challenges that we have, and a lot of this has to do with equity risk premium, and I'll do a drill down on there, and then I want to talk a little bit about what Jared said, and part of the tagline for what we tried to do for our clients at ETF Capital Management, and that is really taming the market, not timing the market. And a lot of people look at me and say, you're a market timer. And I go, yeah, okay. At the end of the day, every decision that we make, in fact, every question that you guys ask me tonight and call in on the show, coming up on after just a little more than 14 years now, is related to timing. Should I buy this now? is what you're asking. Do you like it and should I buy it? So everything ultimately is a timing decision. But I want to kind of reframe that and say, it's really not about timing, because when they talk about timing, it gives the sense of trying to be all in and all out, and nobody knows. The Fed's recognizing a bubble. Listen, markets rallied today in the last half hour after being down for a good part of the day. So, nobody knows how these things are all going to play out. And what we can do is we can recognize when there's some challenges and some risk factors. So what I'm seeing now in terms of market breadth, this is one component of our Pro-I series, but within it and the importance of market breadth, there's actually 3 factors in our 12 tactical factors that look at market breadth and consider market breadth. We're going to look at 2 of them tonight because the third one is still very, very positive. The third one being the percentage of stocks above their long-term average. And while very, very high, there's no strong warning signs. And it's usually a very, very good thing when market breadth is strong. And that is lots of stocks are participating in the rally. And as you would expect year on year, coming off the lows of last year, that most stocks would be participating. But what we're starting to see now is this divergence. And when you analyze market breadth, it's really divergences that play out. So what we're looking at here is the S&P 500, and then the percentage of stocks within the S&P 500 that are above what we'll call an intermediate term trend, or the 50-day average. I like to look at a 63-day average because that's 3 months worth of trading, and the 200-day average is a long-term one. Historically, before the days of computers, the 50-day average and the 200-day average were easier to calculate. So can you, and approximately represented 1 quarter worth of trading days and 1 year's worth of trading. And that's the origin of those averages. But there are 63 trading days on average in every quarter, 91 calendar days, but 63 trading days, and approximately 252 in the year. Now, that's not true for Japan and China and some other markets that have far more holidays and long weekends, etc. So, but the 200-day average and the 50-day average are pretty common. What I've done here, these red lines that are highlighted on the chart, I've just taken a very simple price regression, i.e. what is the average trend, linear, of the last 1 month. And what you can see and what it shows is that while the market has kept going higher, the percentage of stocks participating in that rally has started to turn down. And when we study this behavior and go back over history and make a visual observation, we can see, for example, that in November and December, the market kept going higher and higher and higher, and we started losing momentum. You can only go up to 100 here, right? You can only have every stock. You can't. It's an oscillator, can only go so high. But it's when the oscillator really starts to lose momentum that we need to get concerned. But in November and December, it didn't really lead to anything, and it actually didn't turn down in any notable way until late January. So you can't, these things in and of themselves are not timing things. Just because you see it doesn't mean it's a reason to sell. And that's an important lesson in any indicator. And that's why we have a mosaic of indicators. We look at different time frames, right? 50-day, 200-day. The next one we're going to look at is the McClellan summation index of the McClellan oscillator. And the message from this indicator is actually pretty good. And I've put a link to the McClellan oscillator website. He posts a lot of stuff there. You can follow along. And he does some analysis there that's usually posted with a little lag, but it's free to people. I've been a subscriber and a friend to Tom McClellan, who's the son of Sherman and Marion, who developed this indicator back in the 1960s for a way to look at advancing and declining stocks, how many stocks were going up and down. Now, there's been changes over the years since decimalization. It used to be an advance was at least a quarter of a dollar, right? The bid-ask spread back in the 60s was 25 cents. The bid-ask spread today is less than a penny sometimes if you can trade on these intermarket exchanges that they have, but basically a penny spread. So an advancer today is a penny. It was a quarter. So, it's not exactly the same, but Tom's done a lot of history and studying on his oscillators, and basically it hasn't changed materially since we've gone to decimalization, which is kind of interesting to know. So the more time a market spends above the zero line in the summation index means on average more stocks on a daily basis are going up than going down. And that's good market breadth, and usually means when you get a thrust or a breakout, it's more sustainable. So he talks about simple patterns and complex patterns. And again, I provided a link there, and I would encourage you to understand the indicator. Just because it's at a high level doesn't necessarily mean the market has sold. It should be sold, because as you can see in November, coming off the election results and the Pfizer Monday, followed by the Moderna Tuesday, I think it was a couple of weeks later, where the market we got all the great news on the vaccines and the efficacy, which we're now seeing the benefit of in the States, certainly a bit less here in Canada. So again, market breadth is bigger picture is generally good, but we're just starting to see that negative behavior on the shorter term indicators. Again, not a reason to go out and sell. But when you put all our indicators together, we've said for a couple weeks now, we're at a very, very high cautionary area. And, when it comes to answering your questions every week, I want you to think about me answering them with this kind of risk return graphic, because all the academic research that's ever been done on the investment universe links the return that you get with the risk that you take. And it's not a linear equation, i.e., if you take more risk, you're going to get more return. It doesn't work that way. In fact, the blue line is the actual result. The more risk people take, the worse they tend to do. And the reason for that is because of the emotional part of taking more risk. You have more volatility, more uncertainty, and the more stressed you are about your position, the worse decision making you're going to make. So I think it's important to understand more about what the equity risk premium is all about, because your ability to, especially in the do-it-yourself crowd, your ability to navigate markets and make decisions, it tends to be very, very emotional. And it's a different type of emotion than working necessarily with a financial professional. So the equity risk premium really defines the excess return over the risk-free rate. And we can define the risk-free rate differently. Some people would say it's a T-bill rate, it's a money market rate. Others will say, no, equities are long duration, so you have to compare it to a long-term bond. But because it's risk-free, you can't use a corporate bond, even though it's a company risk. And so we should use a longer-term government bond. And then some people say, well, you should use a long-term government bond, but you should adjust it for inflation, because really equity markets are an inflation hedge. So part of the premium in taking the risk of buying a company versus getting a safe return in bonds, is a big factor. So at the end of the day, the Fed understands that they, in a large part, control the equity risk premium as it pertains to the cost of money. And make no mistake, since the great financial crisis, and really going back until what Greenspan did in the aftermath of long-term capital and the emerging market currency and debt crisis in 97 and 98, by calling all his other central bank friends and saying, hey, we've got a systemic problem, we should all provide liquidity, that became known as the Fed put, and really kicked off the era where people don't really care as much about risk, because they know the Fed, no matter what happens, global pandemic, whatever, and governments are going to provide the support. There's no political will, whether you're running the Fed or you're an elected official, to have your economy crap out because your stock market is weak. And so this is a permanent part of the world, and I don't see it ever going away. And frankly, last year I underweighted it. I really didn't think that what the governments were going to do regarding printing money was going to save the economic fallout. And sure enough, markets just didn't care. They looked right through it, and we're here. So I thought I'd spend time tonight in this last one to kind of talk about some of the things that I have for the 10 weeks now, and bring everything together into one idea and one thought that I think I can share with you. Because the equity risk premium, and you're going to see this on some of the coming charts here, today, over the last decade, we're in the 97th percentile, meaning relative to the recent expansion, we're as expensive as we've ever been. Relative, though, to the past 40 years, we're actually only in the 23rd percentile. The markets are quite cheap here. And the reason the markets are cheap is because money's never been cheaper on a real basis. We're in an environment now where we have negative real interest rates because the rate of interest is less than the cost of inflation. And it seems evident that central banks want more of that. So yeah, we worry about rising bond yields, but at the end of the day, there's just so much debt out there that it's really, it's not going to be possible. And equity risk premium can change for lots of reasons. As earnings power of the market goes up for whatever reason, expanding economy, government printing money, really doesn't matter. If earnings are going up, then the equity risk premium will go down. And the lower the equity risk premium is, the riskier the market is, but the bigger the multiple will get. And so that's obviously a big factor today. The equity risk premium can fall or rise if based on changes in expected volatility, right? And that's the idea of the VIX and a change in rate of the VIX. So that can be a leading indicator for markets going up and down as well. And then there's the liquidity factor. So right now, this week, the Fed announced, the Treasury announced their refunding needs for the next few quarters. I've been talking about this a lot, and the announcement came on Monday, and they need to, over the next 2 quarters, issue 1.3 trillion of new debt, and the Fed is buying 120 billion a month, but only 80 of that is in treasuries. So there's a need to finance about 600 billion more in new debt. And with central banks around the world buying less and less US debt, because for whatever reason, there are very few buyers left of US debt. And I think what we're going to see as supply starts to come out is bond yields start to push back a little. And we'll see how that all plays out. So far, the Fed has been able to talk down the inflation risks. But every day you're seeing a different headline, commodity indexes breaking out and so forth. In part why the Canadian dollar has been so strong, because we're thought of as a commodity currency. And so money flows to Canada, probably for the wrong reasons, actually. We're not as commodity export centric as we were. John Maynard Keynes, famous for saying markets can remain irrational a lot longer than you and I can remain solvent. And the recognition of that, the recognition of similar statements in the Graham and Dodd texts of value investing in the 1930s is the origin of the emotional part of behavior. And I'm going to, again, talk about loss aversion or prospect theory, and the idea that when you have gains or losses, the x-axis on this graphic, you have a degree of happiness or unhappiness. And it's the emotional response. We're wired that way. FOMO is part of the human condition, fear of missing out. So the expansion and contraction of risk premium can also have a lot to do with just people are just okay, they're complacent. But one of the things that Kahneman and Tversky learned from doing all this psychological study is the diminishing value of happiness as we make more and more money. We get complacent, and we can see that in the behavior of the markets. But when the losses start to mount, panic sets in, and that's where the stress comes in the bad decision making. So taking more risk does not equate to a higher return. Taking more risk equates to making worse decisions, right? So again, when people call in and ask, Larry, should I buy this stock? First of all, I don't know if you already own it. I don't know if you have 5, 10, or 20% of your portfolio already. I've got a friend who loves to speculate and make really big bets. And sometimes I'm able to talk him off a ledge and say, okay, make the bet, but just don't put every penny of your TFSA in there. And there was one instance where the company went bankrupt. It was a really high risk thing, and he literally wanted to put all his money into this. And I let him put some in because Okay, it's not zero. Maybe it was going to work. I don't know. Anyways, there was another one that came up recently, and it was one of these SPAC things, and they were taking over a company, and there were some warrants. And he said, "How do I want to go pig on this? I'm really bullish." So he bought some of the warrants and got some leverage, and now the thing's tripled in price from where he bought it from, and he's mad at me because I didn't let him do more, right? And this is the thing. Like, after the fact, it's obvious and easy. And so when you're on one side of the graphic, your logic and thinking is completely different and comes from a different part of your brain, literally, than when you're in a loss situation. And while we all have common DNA in this sense, everybody is wired a little bit different. And that is known as risk tolerance. And we're all different in that regard. Some of us are okay speculating, we don't care, and others of us need far more sleep at night in their portfolios. So, the rest of my talk tonight is really going to be focused on just a framework for how to think about, putting your portfolios together. Okay. The last thing I'm going to say here on equity risk premium. And I just literally, I threw this slide in a few hours ago. Ed Yardini came out yesterday with his update. He always has updates that he posts publicly, and you can check them out on his website. But he tracks the equity risk premium. And what you can see here, and the difference between, where it is today, which is equivalent, pretty close to where it was in 2000 in terms of the PE of the market. So you have that PE turned around is the earnings yield, and it's very, very similar to what it was in the peak in 2000. So that aspect of it is extremely expensive. The difference is, back then, bond yields were significantly higher, and you actually had positive real yields, where today those numbers are negative. And from that perspective, the market's far more expensive today. But when you look at it relative to where bond yields are, it's very, very different. And that's why it's a lot cheaper today relative to the cost of money. The spread, because the spread back then was very narrow. You could earn more in a bond than you could by buying a stock. Your earnings yield. Okay, so that's the big trade-off here. And so today you could, at 2.25, you could buy, because that's kind of where we are today, when you factor out rates. So we're at 4.4 in terms of the earnings yield. The dividend yield's 1.5, but bond yields are negative. So again, very, very cheap. So how does the central bank now back away? If the primary reason for not only the economy recovering and everything else, yes, vaccines are a factor for sure, is the central bank and government support in terms of stimulus and the monetization of that stimulus. Because every recession historically has always been taken away by the Fed raising rates, the economy overheating. They recognize inflation pressures building, and they want to kill that. And this time, they don't want to do that. At least the Federal Reserve is very strong that way, and the ECB to a slightly lesser extent at this point. You remember back in 2012 when Mario Draghi said, we'll do anything. So how is that punch bowl going to be taken away? Because the last time they tried to take the punch bowl away was in 2018, and equity markets had a stroke. And equity markets will have a stroke again, and at least correct 20%, 15%, at least, when the Fed starts to back off. And this is the taper tantrum and everything else. I don't think they can do it. They're going to try at some point because they're going to have to, because the only way for them to curb inflation, if it really starts taking hold, is to stamp on it with interest rates. But the economy will collapse. So many of the new home buyers are so stretched and only able to do it because of cheap money. And if money gets more expensive, the economic stress will be there, and then they'll have to cut rates again. So I don't see a way out of this, and I think interest rates are going to stay low forever, notwithstanding wiggles. The 10-year rate going from 160, where it is now, to over 2, that's a wiggle to me. If we saw the 10-year above 3 or 3.5, that to me would be the end of the bond bull and the beginning of an inflationary cycle, and the economy would collapse, right? So I just don't see it happening. And that's really the narrative on what's supporting the market in my mind here. And it really isn't a strong economy. So I want you to think about, and when you understand portfolio construction, what your goal is really trying to deliver the highest expected return with the least amount of risk. And the Nobel Prize winning work of Sharp Markowitz in 1990 is to build a portfolio that targets this capital market line. Again, the intersection of all the potential things you could own, all the individual things, whether they're ETFs or stocks, everything has a risk and a return. You've got a past return, and then you've got your expected risk and return, your forward-based, what is that going to do? Remember, that's only a guess. We don't know what it's going to do. We have good ways of forecasting those, but really those are guesses. And the way to reduce the volatility and get to that point on the curve is to be in assets that are low correlated, fixed income, other alternatives, gold, other asset classes that have less correlations to equities, which are going to give you your longest run, your longest, biggest expected returns in the long run, because they are the riskiest asset classes. And so the philosophy of the capital markets line and the efficient frontier and trying to build a portfolio to generate the highest return possible with the least amount of risk is still valid. The Nobel Prize winning work there is still valid. It's just the tools that are broken. And what I mean by that is government bond yields are at zero and negative on a real basis. And if you use that as an asset class, your expected return goes down too much. And so while it's relatively safe, as long as you believe the government's not going to default, you're worse off because inflation is going to erode the purchasing power of your money. And you need to have a real return in order to get ahead. So when I and others are saying that this is broken, it's not permanently broken, but the tools that allow us to build these portfolios are broken. And why I emphasized the target-based outcomes ETFs for the series, the first part of this series, was because the only true negative correlation today is buying a put. But buying a put is expensive. Insurance is not cheap, right? Insurance, the whole industry of insurance is built on a profit model. Insurance companies don't lose money unless they misjudge their liabilities relative to their income and assets, right? Obviously, that's a business risk for insurance companies. But the only true protection today is a put, because you're guaranteed to get exactly the inverse and exactly the protection you want. Okay, so that's pretty critical. And so I think what you need to focus on when you're thinking about what to put in your portfolios is not, Larry, here, what do you think of this ETF, right? That's not the question to ask. The question to ask is, what I'm adding today, is this going to reduce my risk? Is this going to improve my expected return? That's the question, right? And if you don't know the answer to this, by all means, ask someone who might have some ideas there, me or anyone else for that matter. But you got to know how it fits into your portfolio and how much you should put in. So that's the critical question here, right? So going back to my favorite statue here, you know, we've looked at a lot of tools. One of them last week, we looked at factors, investment factors, as a way to change the risk and return profile of your portfolios. Erica talked today about another couple of factors, small and mid-cap stocks, as a way to change the volatility and expected return profile in your portfolios. So knowing that mid-caps and small caps generate better long-term risk-adjusted returns than large caps, shouldn't that mean you should have a lot of that in your portfolio? Well, the answer is yes, but not always, because they have more volatility. So when the risk factors are high, you don't want things with more volatility historically in your portfolio. You want things with less volatility. And when the risk factors are low, you want things with more volatility or more potential growth. And that is lower correlated assets, whether it's gold, consumer staples, utility stocks, or in the case of hedging, options and derivatives. And whether that's a simple covered call strategy or whether that's something a little bit more sophisticated that I'm going to drill into a little bit more tonight. So you have to be able to take some level of risk. You can't take zero. And I see a lot of questions like, Larry, my GICs don't pay me anything. Can I buy a dividend paying stock that's equivalent? And the simple answer is no, it doesn't exist. It has a different volatility profile. So going back to the original question, is now the time to be a bull, where the markets are overvalued and the risk factors are high? Well, if you suffer from the emotional problem of FOMO, meaning your friend's making money and you're not, and you need to keep up with that, and you see Bitcoin going up and you just want a little piece of it, even though you don't understand it or how to value it, that's emotional. Understand that's not fundamental. Understand that is the emotional part of your brain. And if you can handle the volatility of that asset class and not get shaken out when it goes through a bad period, then fine, that can be one of the tools in your portfolio. But for me, because I don't understand the value of it, I get that it can keep going up because it's a commodity, and if more money keeps chasing it, well, it's going to keep blowing, all right? It's going to keep going up and up and up because there's a limited supply. And if that's the reason you want to own it, then fine. But understand, when that supply-demand dynamic changes, the volatility on the downside could be breathtaking. So how do you know when this correction is going to be the correction? And the answer is, we just don't know. So again, use it as a tool if you like. If it's volatile, I think the most important thing for most people who are in the do-it-yourself crowd, and I expect that most of the viewers that follow on BNN at least do some of their own investing. They might, a good portion of you, I think it's close to half in some of the surveys we've done, work with financial advisors, but a good portion of you like to do it on your own. And so reducing the emotional influence in your decision making, the essence of what Kahneman and Tversky won their Nobel Prize for in their work in loss aversion, is knowing your prospects, prospect theory. And so it has everything to do with decision making and knowing when to be a bull and when to be a little bit more cautious. So again, reiterating the idea of why we've based this series around the PROEYES indicators, how it can help you determine when the risk factors are high or when the risk factors are low, into knowing when it's probably safe to dip your toe in the water. And right now, we're in cautionary mode. There's no doubt about it. But it doesn't mean the markets can't keep going up for what John Maynard Keynes and others recognized 80, 90, 100 years ago, and that the markets can stay irrational far longer than you can remain solvent, and that the Fed can just keep the party going as long as they don't take the punch bowl away. So again, arm yourself with the tools to understand what that means for you and for your portfolio decisions. And I think for me, that's the most value I can give you. You know, telling you what stock to buy or what ETF to buy, or, you know, do I like it or not? That's all great, and it's colorful, and sure, there's some value there, but really, it's not about that. It's about learning how to make a better investment decision, and why I focus part of the show every week on trying to learn something for everybody. So, you know, should everybody, I think everybody should start with an all equity portfolio, especially nowadays. I think putting money in bonds is the dumbest thing you can do, because you're going to be worse off after inflation, tax, and fees. It's a bad investment. However, it's a tool, and if you know how to use it, it might make sense for you. Most people don't understand it, but the hardest environment for bonds are when inflation risks are high, and they've never been higher in my professional career that started in the late 80s, because interest rates have been falling since the high inflation of the 60s, 70s into the early 80s. We've only known disinflation. We've only known periods where inflation is falling. And now you've got most of the free world wanting more inflation and tolerant of more inflation. And that is a terrible environment. However, if you're 80 years old and you need money to live off of, can you afford the value of your portfolio and your dividend stream to get cut in half? Right? And for most people, that answer is no. So that means you need to know how to protect when you need to know how to protect. You need to know how to minimize that volatility, because it's going to happen. But the facts are very simple. In the long run, the markets always go up, right? But the peak in 1929 wasn't exceeded for 23 years in the US market. So there can be long periods, years, where performance is terrible. Now, I would have thought, and I did think, we were going to get much, much more severe economic shock. And I'm so thrilled, I can't tell you, that the vaccine efficacy and how fast they were able to come to market with products that work. And so, you know, very, very, very thrilled for that, for sure. But you can see the facts here. You know, daily markets go up 52% of the time, weekly 58, annually 67. If you measure that by decade, there's never been a decade where stocks haven't gone up, except on a rolling basis. You can find periods from the 29 peak right through to about 1942 or 43, where that 10-year window was always negative. Or something around that. Anyways, you get my message there, I hope. So I think it's 20 years where you've never had a negative return, and that return wasn't in excess of equities. So if your horizon's 20 years or more, everyone should have 100% equities, and just simply go buy the Vanguard Total World ETF. That should be your starting point, right? Just buy the most diversified global portfolio you can imagine. And if that's and never look at it, frankly, just keep dollar cost averaging, and whatever your savings are, just buy more every month, right? That is the smartest thing for most people to do. But you also have to know that every few years you're going to, with certainty, like clockwork, except it's not right like really a clock, and it doesn't go around, and you can't time it. But you're going to have a 20% drawdown guaranteed at some point. And every 10 months or so, you're going to have about a 7% drawdown. But sometimes it's 12 months, and sometimes it's 14 months, and sometimes you get 2 within 6 months, right? And it just depends, and you just don't know. And then once a decade or so, you're going to get a Papa Bear and one of these more significant drawdowns like we saw last year. But you can't time it. You just have to know that it's part of investing, right? And if you can't handle that volatility, then you can't have a 100% equity portfolio. And therefore, you need to learn how to do these other things, because historically it was fixed income. And I'm telling you and suggesting that for the next decade or two, bonds are going to be an atrocious investment to give you your balanced and low volatility in your portfolio. And those of you who work with financial advisors, ask them about it. Ask them their opinion. I think it's very important you understand that element of what they're doing for you, because it's broken, ladies and gentlemen. You're not going to reach your financial goal. If you need 6-7% from your portfolio to meet your long-term goals, and bonds on average are going to give you nothing after inflation, your equities need to give you 12 or 13. And the history, as you saw with Erica's numbers there, they don't do that. And they don't do that from a very high point, okay? And that's really important. So Leon Cooperman, who was on CNBC and Bloomberg, and David Rosenberg hosted a webinar with him a few weeks ago, and very famous hedge fund manager. When you bought the S&P 500 historically at 22 times earnings, your 5-year return was near zero. That's where we are today. That's why the valuation part of our model, of our PROEs model, is saying like extremely high caution. But it's been in that area prior to COVID, and it's back there again. So what Warren Buffett tells us, that if history was all we needed, then the richest people would be librarians, right? Which is a very cute quote that I pulled off the internet this week, and I thought was very interesting. So the most important goal, the most important document, the most important thing you do is gotta be your financial plan. And your portfolio should be geared around your goals, not your wants, not your FOMO, not your I'm not making enough. You should guide your portfolio goals around what you need to achieve your personal, suits your personal risk and suits your, what is my life going to look like when I'm not working anymore? And whether that for some of you is 55 plus or 45 plus or 70 plus, whatever that is, that's how your portfolio should be guided. Okay, and it's very important. Again, the most important document you should have is probably your financial plan. So when someone asks a question, this is what I do, and this is what I do, and I showed you last week. So I'm bringing back the chart from last week as we looked at Skyworks relative to the equal weight technology index here, and that's what the yellow line is. It's Skyworks relative to the index. I want to be at my full position when I'm at the low end. So when there's some relative value in something I want to own. So I've decided that I like it fundamentally, that there's some reasonable valuation and that there's reasonable upside. And for me, I want to be able to make 20 or 25% realistically over the next 12 months if I'm going to hold that as an equity in my portfolio. And I will trade the positions around. So if I'm holding a 50 stock portfolio, a full position is going to be around 2%. And so let's say Skyworks is one of the names I want to own in that 50 stock portfolio. At 195 right now, one standard deviation above the trend of the last year, and about neutral relative to the technology sector, be around half a weighting, so that if it goes to 175, right? If I liked it at 195, shouldn't I like it more if it's lower, right? The question always has to be, what should I own? And if I've decided fundamentally or technically or whatever drives your reason to want to own something, how much should I own today? And to get that, you need to have an understanding of the volatility of the stock and of the potential return, right? And if you don't have that understanding, you're at a severe disadvantage. But what I can tell you for fact is that the expected return goes up from a low point compared to a high point, okay? So again, trying to buy a breakout to a new high, you can look at the July, August. So you saw in September, you saw a new high relative to August, and then it failed back into the range. And in October, you saw a new high relative to September, and then it fell back into the range. And then you saw a breakout finally in January, and then it came back to the range and it held. And the moral of that story in looking at the behavior is you don't know if that new high that you see now is going to continue or it's going to fail. You just don't know that. And sometimes it will and sometimes it won't. And all my studies of history tells me that is a real challenge for my style. But also what I learned by studying charts like this is that if I've decided I want to own it fundamentally or technically, if I buy it when it pulls back to support, my expected return relative to my risk, in other words, the core essence of trying to get a higher average return with less risk, the core essence of the cornerstone of analysis and investment, the Nobel Prize winning work of these brilliant gentlemen is all around the expected return and risk. And what I can tell you is buy low, sell high equals more sleep at night, okay? I know that for a fact, and that's just my style on how I invest. But the challenge is you don't know when the bottom's going to be either, much like you don't know where the top's going to be. And that's where the sizing comes in. When we think about buy high and sell higher, there's nothing wrong with momentum type investing at all. In fact, most of my technical friends are trend followers, right? But when you're a trend follower, you have to take more risk. You can't follow a trend like this unless your trend line is well below the lows. So that means a stock that you would buy today at 195 or last week, it wouldn't be until it probably broke below 150 or so that you would sell it. And the simple question I have for you is, boy, if you liked it at 195, what the hell are you selling it for at 150? Right? Well, then the conclusion that I make from that is you bought too much at 195 because you should like it more at 175, right? And therefore you should like, if you fundamentally like the stock, why are you selling it at a lower price? That to me is the definition of insanity. So the question then is, I like it. How much should I buy at 195? And when I look at this chart, the answer would be I would at best have a 25% position in it, right? So, depending on your framing, and this is how I think about investing and when to build. And really the most important thing is thinking about diversification, okay? So I think about, I want to own the best stock in the best industries. Now there's 11 sectors of the market. So telecom, now it's called communication services. They broadened it out to include internet names and marketing. So if you look at interactive media services at 5.97%, and you look at what's in there, Google is in there. I think Facebook falls in there. When you look at movies and entertainment, I think Netflix is in that one. What else would, so then the consumer sector, and there's a lot of different ways you can play consumers, right? There's hotels, there's auto sales, there's restaurants, there's traditional retail sales, clothing, there's leisure products, there's indirect marketing. Well, that weight is so big there in that sector on market cap. Well, that's Amazon. So and then there's the defensive side of the consumers, the soap, the soft drinks, things people need all the time, right? That even if the economy's bad, you still need your drug retails, right? You still need to go to your convenience store and so forth. Now, you may trade down and do more shopping at your discount chains, but that's an individual choice. But on average, you tend to see that. So consumer staples do better. And so you may want to have more consumer staples in your portfolio, good dividend paying names that you like. And think about, I want the best one in household products, and I want the best one in personal products. And if you happen to not like tobacco, so maybe you don't own one of those, it's not the end of the world. It's a tiny part of the index anyways. Do I own Coke? Do I own Pepsi? Do I own Monster beverages and US large caps? If you expand that to include small caps and mid caps, you have a lot more selection, right? Hypermarkets, Walmart falls into there, and so forth. So that's the idea. Think about, I want to diversify. Owning 5 bank stocks, you're not diversifying. You're diversifying within banks, but you're not diversifying your risk. And that's why the TSX is such a crappy index, because it's so concentrated in a few areas, and obviously banks are one of them, because they all go up and down together. If there's a problem for banks because the yield curve's flat or inverted, they're all going to perform poorly on average. They're all going to have hits to their net interest margins, right? Some a bit more than others, and so if you own all of them, you're diversified. But the reality is you've got concentration risk. So buy the best one. What's the best one, Larry? Well, I don't know, right? But the two that I would be looking at now are TD and Royal. I think they have the combination of capital markets, and they're just better diversified than some of the other banks are geographically and so forth. Healthcare, we have almost none of in Canada, so you got to look elsewhere for that. Industrials, again, we have almost none of in Canada. You got to look elsewhere for that. We're okay. We've got 2 great railroads here in Canada. We've got 1 airline, basically. I mean, we have 2, but you know, anyways, you know, point being, we don't have a lot of stuff in Canada. So the higher the beta of a stock, the more correlated the stock is to the market, the more market risk it has, the less stock specific risk it has. So high beta stocks, you know, stock can go down because the market risk has changed. What changes the market risk? The biggest single factor is the equity risk premium. And I talked about things that drive the equity risk premium: cost of money, expectations about volatility, liquidity factors, and everything else that people change their opinion on. The higher the beta of the stock, the more sensitive it is. You should really only sell a stock that you like if the reason you bought that stock has changed, meaning the growth potential's gone, the dividend, you bought it for the dividend and the dividend's been cut. There's got to be some reason that you'd want to sell that stock. Now you can add to it and you could take away, like I do. I add to a position, I take away, I trade around a core position of a company I like. But I'm always going to be invested in my portfolios, and I'm going to take the market risk out of the idea of trying to be in and out. And this is the essence of taming the market. Okay, this is the idea of taming your portfolio. And I learned this, I learned this from George Soros, actually, from something 25 years ago. I saw a presentation with Soros, and he talked about this thing called the hedge ratio. And you know, we put a hedge on our portfolio. We buy put protection or use futures, in his case, to protect the value of the portfolio against risk we can't control, right? So if there's company specific risk, and that's going to change the outlook for the company, not 1 or 2 earnings quarters, but fundamentally change it, well, that's when you should be selling the company. It's not something I want to own anymore, right? But if it's still a company you want to own, but the whole overall market risk is coming down, the multiple shrinking, so everything's falling, this is where learning to hedge your portfolio adds tremendous value. And again, why I introduced the idea of these ETFs that do this for you, because truth be told, the average investor isn't going to be set up or cut out to do this. And it's certainly not for everybody, but this is the core part of the things we do in our portfolios for our clients. And so if you look at the potential of hedging portfolio risk, so when my PROEYES indicators get to cautionary levels, what I will do is I will look to put on a collared put spread, and that is buying put protection down to where I think major support is, to the horizon, the time frame I think I need that protection. And so right now I've chosen the end of September, because seasonally that's the next big pocket of weakness in our PROEYES indicators. And I think it's going to be meaningful, especially this year, because of the debt ceiling limit and the need for Fed funding and all that supply that's going to come out in July, August, and September. It's less for the next couple months, but July, August, and September, that goes from it's like $500 billion of deficit over what the Fed needs to, the Fed is buying, something like that. So I think that's where the bigger stress comes. But right now, there's lots of reasons for the equity risk premium to reflate, to move higher a little bit. So what I've done is, knowing that the markets can stay irrational, I've looked at what the year-end targets for the market is, and strategists right now are about 4,150 as the year-end target, which is almost about where we're sitting at today. So if the average strategist is right, which they rarely are, but if they are, we're already fully priced, leaving room for some more irrationality. If I put that topside call, selling that call 5% higher helps pay for the insurance. And so this strategy on a net basis cost me $29.40. This was snapshot was as of the weekend. It'd be slightly different today. But you can see the cost line. So if I want to protect between now and June, the cost is going to be much higher. Okay, just because the premium I'm earning relative to the volatility at the money is not as favorable. So the longer you protect, the cheaper it is, the more room you can give yourself on the upside as well, in case the markets get even more irrational. But if on September 30th, we're at 3750 on the S&P, 100% of my downside exposure is protected. And it's costing me $29. And so if the S&P right now is trading at $41.81, based on the spot close on the weekend there, right? Because the factor is 100 in terms of units of options in your protection. I'm spending about 0.75% for this strategy to protect my portfolio for the next 6 months. And so that the question you have to ask yourself is, does that make sense? And if you can put this in a marginable account. So it's got to be in a margin account. And for a very low cost, you can protect the value of your portfolio. Now, the correlation of that portfolio needs to be similar to the broad US market, right? You're not going to be able to protect a gold stock because it's uncorrelated with the US stock market. You're not going to be able to protect much of a consumer staple that has a low correlation with the S&P 500. The S&P 500, as Erica showed you tonight, is dominated. 70% is by the top 100 names. The top 10 names is 25%. We all know who those are. Large cap tech. So if you have a lot of large cap tech in your portfolio, this is a great way to protect it without having to generate tax by selling out Apple. Maybe you have long-term capital gains in Microsoft or whatever, right? So I think managing risk separately than having to try to time the market and go in and out. And I think this is the most effective way going forward, possibly for the next couple of decades, because bonds and other traditional ways of lowering risk in your portfolio are impaired for a while. So I took a long time tonight, folks, to really go through this. I wanted to really drill down for you. And a question came in about stop loss levels on holdings. And as I'm saying, if you feel you need to use a stop loss, you probably shouldn't have bought it in the first place. But that's a trading technique. That's not investing, right? So buying something and hoping it goes higher and trailing a stop up like that's valid. There's nothing wrong with that technique at all, actually. And so how do you do that? Is there a rule of thumb was the question. And I took that first because I thought it was an excellent question in context of what I've been talking about. And there really isn't a level. Again, if you liked it at 195, you should like it more at 175. So make sure that you buy the amount at 195 so that if it goes to 175, you're actually adding to it and bettering your position. But once that position becomes 2%, or whatever your maximum is for the type of portfolio that you're running, defined by your own personal risk tolerance, okay, very important there, okay, that then you say, okay, when do I need to sell this? What is, and I think that's more fundamental than technical, right? I don't think that's about chart points, but in the idea of behavior and what breaking of support levels mean, that if a trend is valid and strong and that trend breaks, you know, that could be a reason to exit a position or reduce a position. And so trend lines, moving averages, previous lows, those are all things to me that you can bring in for risk management purposes. And what you use, there is no rule of thumb there, by the way. What you use has to be defined exactly by what your goals are. And that is exactly related to the financial plan you've done. So when you sit down with Monique Madden, who is, I think, one of the best planners in Canada, and go through your needs assessment. And Monique runs our U Potential and is head of our U Potential financial planning. And pardon me for putting in a plug for her, but she's so lovely to deal with. And you have to understand what your goals are. You have to understand minimizing your taxes. You have to understand all those things about in the latter stage of your life, how can I do better for myself by reducing my tax burden and all those things. And it's such an essential part. And then you can gear your portfolios around that rather than worrying about necessarily where do you put your stop. And the person who wrote the question and says, I ride the elevator down too long, too often. And that's probably because you're in high volatile stocks. You don't know why you're in them other than they mention them on the Fast Money show, or it's GameStop and it's moving. And I'm telling you guys, that game is just too damn hard to do well unless it's a full position on job for you. And even the guys that do it real time, you know, the guys that don't do it well get weeded out, and they're out, and there's a survivorship bias, but it's very, 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 you know, difficult to do. So let me get to some of the questions here in our last a couple minutes. Can I explain the reason why the Canadian dollar is increasing that much? And it's really, Canada's a commodity currency, and therefore we're an inflation hedge, and therefore money runs into the Canadian dollar that is looking for hedges that are related to things that will do better for you when there's inflation. And the Bank of Canada has not given any indication yet. I think they're getting closer, because the stronger the Canadian dollar is, the worse the Canadian economy is going to do, because we inherit import price inflation. And Canada is a twin deficit country, meaning we have general capital outflows and we have trade outflows, and we don't export enough because they won't let us build any more pipelines. Anyways, pardon me for that. So that's largely why, and I think we're in an area where the Bank of Canada very soon will start saying we don't want it anymore. Do insurance companies benefit from higher rates as banks do? What's your opinion? So the answer is yes. When new money comes in, insurance companies have a liability. Generally, they factor insurance policies based on where they think they can earn to pay those policies over long periods of time and so forth. So generally, yes, is the answer. But I don't think interest rates, other than shocks, are is going to to do a lot more on the upside in terms of higher rates. And rates are going higher because inflation costs are building, and that's not necessarily a good thing for companies that rely on debt as a way to meet their obligations in the long term. The higher inflation is, the cheaper that debt gets, by the way. So that is a positive there. Anyways, it's 8:30. It's been a great webinar series. Thank you all so much for participating with us. Thanks for following me on Berman's Call. Again, love doing this stuff. I'm all about education. Keep the cards and letters coming, as they say. Never hesitate to ask a question. I try to get to as many as possible. And have a great summer, folks. Be safe and get your vaccine shots, and we'll see you in the fall. And be healthy and happy. And if you can support one of our charities, if that makes you happy, then I'll be thrilled to match your donation. So thanks again.